The average American doesn't even know that passive real estate investments exist. Or if they do, they might think of like REITs, real estate investment trusts. They might think of crowdfunding platforms, but they don't know much, if anything, about private placement investments like
You know what,
syndication.
Brian? Some people think that passive investing is actually active. They
Oh, yeah.
confuse them.
Yeah. Or vice versa. They think that like rental properties is a form of passive investing. It is absolutely not. That is a side hustle, it's a business. And you and I know that because we've done it. Uh, between the two of us, we've owned dozens of rental properties. And I can tell you right now, it is a business. So, real passive investments are things like uh, syndications, private equity funds that own real estate. It could be private notes secured by real property at a fixed interest rate, or even at some kind of varying interest rate that it pays based on performance. It could be a private joint venture partnership, a JV partnership with an operator. That could be a house flipper. It could be a rental investor. It could be a spec home builder. But these are all forms of passive investments in real estate, and most people don't know anything about them. So we want to demystify some of that today, pulling back the curtain and going through an exercise of a real passive investment that we are going to be making in our co-investing club in a few weeks from now. So we're going to walk you through this step by step. We're going to show you the pre-vetting worksheet that we went through. And to tie this back to, the average American not being familiar with these, even people who do know what syndications are, for example, or passive JV partnerships, private partnerships, they struggle with three things. They struggle with finding these, right? They don't know how to
Mm.
find them in the first place. So deal flow is what people in this industry refer to that as, finding consistent deals and good deals. They don't know how to vet these deals. Speaking of good deals, they don't know what a good deal looks like versus a bad deal. How to analyze risk and evaluate that risk piece. So the average American doesn't know how to find these deals. They don't know how to vet these deals, and they don't know how to fund these deals because most private passive real estate investments require a minimum investment of $50 to $100,000, which is not chump change, right? For most of us, and this is why these have been the playground of the rich for many decades now. And by the way, that's equivalent to what you would have to cough up if you were going out as an active investor buying rental properties, right? Between the down payment, the closing costs, any initial repairs that you have. So 50 to 100 grand for each real estate investment that you make, whether that's active or passive, that's a lot of money. And that is the other challenge. We're going to talk about all three of those things today and how you can get around all of them and how we personally invest 2,500 or more at a time in these passive real estate investments. So with all that being said, welcome to the Bucks Outside the Box show, where we challenge conventional money wisdom. We get a little contrarian and we try to think outside the box, right? All right.
So, Brian, let's start off. How do you even find these deals?
Well, we find these because you and I spend half of our time networking with operators, right? I mean, this is part of the service that we provide as the organizers of the co-investing club. So we go out, we first of all we ask around among everyone we know in this industry, who do you like, who do you respect, who have you invested your own personal money with in the past and had good experiences with. So we'll get these word of mouth referrals to operators who are doing really good work. And then we schedule calls with them. We get to know them. We pre-vet them. We ask about their track record. We ask about investments that have gone awry because investments, something's always going awry with real estate investments, right?
And that's
Yeah.
one of the really good questions everybody wants to make sure they ask is tell us about something that went wrong, in your past deals and whatnot.
Right. And how you adapted, how you now underwrite for that and that deals differently, right? How have you changed your investing strategy, based on these experiences of when things have gone wrong? That's how we find operators. I mean, but again, this is part of our business. I mean, we are actively going out and meeting with operators every single week. Whether that's operators we've never met before or operators who we already have a relationship with, but we want to check in with them and see how they're doing. And that's part of the service that we are providing in the co-investing club is consistent deal flow. So we have, we have deals constantly coming across our email inbox because we are networking with operators and they email us every time a new deal comes along. So that's how we find deals. And this one that we're going to walk through today is a deal that came across our desk a week or two back. It's one that we are going to be moving forward with in the co-investing club over the next couple weeks, at least as the time we're recording this. By the time we record this, we might be getting ready to hop on a big deal discussion call in the club to vet this together as an investment club. But we're going to walk through our pre-vetting. And that is, by the way, that is really important to us that we vet these deals as an investment club. So we've got a call with 50 other investors on them, all trying to poke holes in these deals from 50 different angles, and that's part of our vetting process as well.
Yeah.
But Cindy and I, of course, do pre-vet these as the organizers of the co-investing club. So on that note, let's dive into this specific deal. This one, in some ways, is kind of a classical value add multifamily deal. But that being said, there are a couple of things that's different. One, this is a much smaller than usual deal, 21 units. And then the other way that this is kind of different is these are townhome rental units as opposed to apartments. So that attracts a different type of renter. And it lends itself to a small community of townhomes. So this particular property, this community of townhomes, is in a college town in North Georgia. Because we have to sign confidentiality agreements and so forth with operators, we're not going to name the operator on this public episode today. Um, and we're not going to name the exact town in North Georgia, but it's a college town in North Georgia. The way that we found this operator, they were referred to us by a financial planner who is in my mastermind group, who we have a relationship with. He's invested with these guys before, this operator before. He likes them. So they were referred to us by someone we know, like, and trust, right? That's part of that. That's an important component here.
That's a big, important component because people reach out constantly just from hearing, what we do, and you have to be very careful.
Yeah, absolutely. So these guys do have a good track record. They've done 14 properties in the past. Of those, several of them have gone full cycle. One of them has sold for profits. Three of them have been refinanced to return all the investors' initial capital, and they are continuing. Those investors are now continuing to just collect cash flow on these. So that is another form of going full cycle on these, where the investors have gotten their money back plus distributions and cash flow. Now they're continuing to earn that cash flow into perpetuity, right? So these guys do have a strong track record. That is part of, what we were just talking about, pre-vetting operators, not just the deal. And in fact, we would argue that it's actually much more important vetting the operator themselves than the deal. In this industry, they talk about betting on the jockey, not the horse, and that's what they're talking. So as far as property management goes for this specific property, these guys have in-house property management. And that is not the important thing. Some operators are vertically integrated, as they say. They handle construction and renovations, they handle property management. That's
There are
fine.
positives, though, with
There are
this.
positives. Yeah, absolutely. But the most important thing is how many properties has the property management team, whether it's outsourced, whether it's in-house, how many properties and units has this team that's going to be working on this upcoming deal? How many units have they worked on with the same operator in the past? And in this case, I think it's 8 properties, all in this area in North Georgia. A cluster of towns in North Georgia that they've already worked on before. And again, in this particular case, this operator manages in house. They have a team that lives there locally that manages these properties. So there's a strong track record of this property management team working with this operator in this exact region in the past, and that's what we want to see. That's really
We're
important.
hands-on too, because everything is right there.
Absolutely. Same thing with renovations and construction management. We ask that question, who's doing the work and how many properties have you worked on with them in the past, right? In this area. Same thing, vertically integrated. This company has an in-house team that does repairs, renovations, maintenance work, etc. As far as the local market, let's dig into some of those details. Again, college town, North Georgia. Uh, this particular uh, this particular town has seen 6.4% population growth since 2020, which is above average or above the national average, not by a ton, but a little bit higher than the national average. Um, Unemployment rate in this town is 3.2%, which is quite low, of course, and it is lower than the national average of 4.3% at the time that we're recording this. Um, Income growth is faster than the national average over the last couple years. Um, and as far as vacancy rate, we try to look at the vacancy rate in the submarket compared to the national average. Now, in this particular case, the vacancy rate is higher. That being said, much of the housing in this area is seasonal. So it does sit vacant, and that skews the number, is basically making that whole notion of vacancy rate, um, you know, almost irrelevant for in this particular case, just because of this submarket. There's a lot of hospitality, Airbnb. There's a lot of second home and snowbird kind of owners here and
Which
renters.
is also important to gauge the area to, everything like what kind of shopping and employers and whatnot.
Well, exactly. And it goes to show that these are not just numbers in a spreadsheet. You do need some context, right? You do want to get a more nuanced understanding of the local market. As far as political risk, which is something that we look at with multifamily properties, but not with industrial or retail, but you do have to look at political risk, which is the landlord tenant laws in this market. How tenant friendly are they? How owner friendly are they? In this particular case, Georgia leans landlord friendly, it leans owner friendly.
Mhm.
But that is important. And we have seen that play out where in aggressively tenant friendly markets, it makes property management much harder, right? It's harder to remove uh, rotten apple tenants, people who are super
Oh,
disruptive or who don't
it
pay
can
the rent
be a
consistently.
total nightmare and lost rent and yeah.
Absolutely. So we are willing to invest in tenant friendly markets, but normally in other types of real estate, right? Things like industrial properties, maybe mobile home parks with tenant owned homes so that those landlord tenant laws don't apply. Um, but in some other kind of real estate as opposed to just straight up multifamily. And, we will occasionally make an exception to that rule if there's some kind of mitigating circumstance.
Right.
Uh, but in general, we don't want to invest in markets that are super tenant friendly because that adds risk for us as investors. Uh, Debt risk. In this particular case, it is a 7-year loan term. That being said, the payments are 3 years interest only in the beginning to help stabilize the property. After that, it's a 30-year amortization for calculating the amount of the payments, but 7-year term. Uh, this particular loan is 6.5% plus or minus a quarter point, and that will get locked in before settlement. The exit strategy for this particular property is on the shorter side. The plan A is selling this property within 3 years. If it's a bad market for selling in 3 years, they'll hold it, until up to 5 years, or maybe even a little bit later if it's not a good market for selling. But plan A is to move in to these, or take over management of these properties, upgrade them, gradually raise the rents over the course of 12 to 18 months as they're renovating units, but not forced turnovers. They're going to be renovating these as they organically become vacant.
Right.
Upgrade the communal areas and the signage and that sort of thing. And
And
then,
just a side note, you do want to make sure that if plan A doesn't work out real well, that they definitely have a very good, solid plan B.
right, and that is why you want to see that runway with the loan term. That's why it's nice to see that 7-year loan term in this case, because yeah, then you and I talk all the time about how deals fall apart, real estate investments fall apart for one of two reasons. Either the operator runs out of money or they run out of time. So we've seen that play out obviously over the last few years where, some investors, some operators got variable interest loans and they became cash flow negative because their mortgage payments went through the roof and they ran out of money, right? Other operators had a fixed interest loan, but they ran out of time. The loan term came due and it was a bad market for selling, also a bad market for refinancing, and they were forced to sell at a loss, right? Because they ran out of time, even if they had been cash flowing perfectly fine with that loan. So that's why we like, even though this operator is planning on a sale after 3 years as plan A, they have a runway of up to 7 years in case 3 years from now is not a good market for selling. So that's what we want to see. We want to see that extra runway there in case they need it, in case the deal needs it. Um, Cash flow, this property is going to cash flow pretty well from day one. And you can see that in the distribution projections, where after the first full quarter of ownership, they're going to be paying 8% distribution yield, at least per the projections. And
Right.
we feel pretty good about those pro forma projections. We feel that the underwriting was, in fact, pretty conservative. And this is the thing, every operator claims to use conservative underwriting, right? They all claim to be conservative in their underwriting. A lot of them aren't. So you have to actually sift through the underwriting and the pro forma to get a sense for how conservative is it really? What kind of rent hikes are they building in there? What kind of expense hikes and expense increases are they building in there? So in this particular case, for example, it's underwritten based on a much higher um, uh, insurance premium than what they are actually being quoted from their insurance broker.
Right.
They are basing the property taxes on the purchase price, even though historically the assessment only goes up to around 75% in this market in North Georgia of what the purchase price actually is. So we see these kinds of conservative underwriting in the performer, which helps us feel more comfortable about these deals. By the way, in this particular case, the preferred return is 8%, and that's a 70-30 profit split. But that full 8% preferred return, they are projecting to be able to pay out in distributions every quarter to investors for this deal, which is always nice, right? It's comforting, as an investor when you start getting those consistent distributions over time. An 8% yield is pretty high yield, right? It's pretty solid. Um, yeah, I mean, I personally plan on investing my own money in this deal, as I try to do with every deal that we look at together in the co-investing club. And then cash reserves is around $200,000 for this particular property. Again, this is a smaller deal, 21 units. The entire cost of this deal is around $3 million. Um, so it's, $200,000 might not sound like a huge cash reserve, but again, for a smaller deal like this, that's reasonable. And then the sponsor skin in the game in this deal, how much money the actual operators, how much of their own cash they will have in this
Brian,
deal.
can you explain why that would make it a stronger deal that the sponsors have skin in the game or not?
Sure. More of their own money to lose if this deal goes south, right? And more incentive for them to make sure that this deal performs really well, and that they have a close eye on this deal, not just in the beginning, but throughout the entire management of this deal. So they typically have over 10% of the equity in the deal made up with their own cash. In this particular case, they have a blanket policy of having a bare minimum of 5% of the equity made up with their own cash, but normally it's over 10%. And of course, like we just talked about, we like to see that. We want to see operators have some of their own money in the deal. Have some of their own skin in this game. Denny, is there anything else that you wanted to bring up about this particular deal? As we just walk through, some basic underwriting, or some pre-vetting that we did for this deal.
Don't think so. I think we pretty much covered a lot of it. Yeah.
Well, we hope you guys got some insights, behind the scenes, how we look at some of these deals, how we pre-vet some of these deals that we look at every month in the
And
co-investing.
I just want to interject one thing. We pre-vet them, but the best part of this as well is that we have this club of 200 or 300 members from, accountants and attorneys and construction experts and all kinds of things that are also vetting these deals and asking questions that blow my mind all the time, which helps. It's important because I think that no matter how smart or great we all are at looking at deals and putting it all together, there's always somebody that has a different spin or a different side.
No question. And that brings us full circle to what we were talking about at the beginning of this episode, how most investors, even if they are familiar with passive real estate investments like this, they don't know how to find them, they don't know how to vet them, and they don't know how to fund them. So finding them, yeah, it's part of what we do in the co-investing club. Once or twice a month, we are meeting as a club to vet a deal together. So that's consistent deal flow. And it also covers the vetting, like you just talked about, how to vet these deals. We all vet them together on a big Zoom call as a club. And then as far as how to fund them, the minimum investment for these, like we talked about, is normally 50 to 100 grand. In this particular case, this deal, minimum investment of 50 grand. But because we are all merging our money together under one joint entity, one joint LLC to invest in this deal, each individual club member can invest with $2,500 or more, or $5,000, depending on their membership level. But collectively, we will likely invest $500,000 in this deal. So, a person might invest $5,000, but we, as the joint LLC, will be investing $500,000, right? So that's the beauty of an investment club like ours. So if you got a fresh perspective out of this episode, please subscribe to the show, rate it, review it, pass it along to friends and family. And if you didn't get anything out of this episode, let us know. Support at sparkrental.com. Hit us up. Let us know. And lastly, consider joining us in the co-investing club. We have a free membership option for people to just come and attend deal discussions, see what we're all about. We also have a free video course on how passive real estate investments work. If you want to learn more about that, sparkrental.com/free. It's a quick video course with 5 to 10 minute videos, super snappy and quick. And on that note, stay weird, unconventional investor.